The thought for this and the saying for the day is the way to the top is off your bottom. I like that one. That was pretty cool, I thought. There's 3 books that everyone should read if they're interested in negotiation. And the first one is Never Split the Difference by Chris Voss. And the other one is The Like Factor by Jack Schaefer. I've studied those 2 books for years because they really complement each other. And Jack just wrote a new one that I just got finished doing this week called The Truth Detector. It's a really good book. So those 3 books, if you're interested in negotiation, are pretty awesome. I've got a market report for Midland. And in December, the homes that were sold were 238. The median sales price was $289,000. Homes on the market were 773. The inventory was 3.7 months. And this is an article I clipped out of the paper. It's 22 January. And it says that the market was the 28th straight month that the average home in Midland sold for more than $300,000. And in December, homes sold for $5,000 more than they did in December 2019. So we're still climbing. I'm not sure why, but well, I know why. It says that we also have one of the strongest markets in the nation, and that our cost of living increase is the second lowest in the nation. That surprised me because things are so expensive here. But we also have a good income here, and that's why we got second to the highest, or to the lowest. Our speaker tonight is Deven Munns. He's with KKOS Lawyers. They seem to concentrate in the tax field. Mark Kohler and Matt Sorensen have 2 podcasts, and I listen to both of them all the time. Main Street Business Podcast. If y'all want to listen to that, every 3 weeks, you can send questions in, and they'll answer them for you on the air. Now, they can't be too personal, so they got to be kind of general so everybody can benefit from them. But still, it's a way that you can get some of your questions answered that you're kind of wondering, do I need to call a lawyer for this one or not? And, sometimes they'll answer half of it, and then they'll tell you, the rest of it is going to be too personal, and they got to know more about your situation. But probably 90% of the times they can answer your question on air, and that way you can figure out what you need. The second podcast they have is Directed IRA, and it talks about self-directed IRAs and 401ks. And what I like about it is it tells you the nuances of it. I've read Matt Sorensen's book probably 3 or 4 times, a wealth of information in there. And it tells you what you can and cannot do. If you break some of the rules, if you got IRA, it can make that whole IRA come out of the IRA in 1 year. So if you had $500,000 in a Roth IRA, you could get taxed on $500,000 in 1 year. The 401k is a little more secure, because if you do a deal, let's say you had $500,000 and you took $50,000 and did a deal, and that deal was bad, then only that $50,000 would come out of the Roth at that time. The rest of it would still be secure inside of your 401k. Deven, he's a tax lawyer. He's one of my lawyers. Matt and Mark and Deven, the 3 of them are my lawyers. Matt's done 2 or 3 of my LLCs for me. He helped me get my 401k going, and he just got one of my LLCs transferred from a regular LLC to a series. And so he's pretty sharp, and he's here tonight to tell us what kind of tax changes he sees coming up with Biden in office and stuff. So just remember that no one here, including myself, is giving legal or accounting or professional information. It's just for your enjoyment. If you hear of something that sparks your interest, You can call Deven up, or you can call your own lawyer or your own CPA and get some information and follow through on what you hear tonight. Okay, Deven, it's yours. Take it away.
Thanks, Lee. Thanks for having me on here today. I'm excited to talk to you guys. And for those who are going to be listening in the future on the recording, hopefully this is informational and you're able to learn a little something from today's conversation. Just a little bit of background again on us. I work for KKOS Lawyers. I am a tax attorney. Don't fall asleep. Don't change the channel just because I said tax attorney. Okay. Most boring profession ever, what a lot of people think, but it's actually super exciting. Okay. I was on a phone call. This is huge, right? I was on a phone call just 2 weeks ago, and I was talking to an investor from New York, and on one phone call in a half hour of my time, I literally saved him $1.6 million in taxes in a half hour because he was about to make a mistake. And I talked him out of making the mistake and explained to him how much the taxes were going to be, and he decided against it. So this is a very exciting field, if you ask me. I'm passionate about it, and I love it. A little bit of background on me, just so you guys get to know me a little bit. I was in real estate. After I graduated high school, I didn't go to college. I started building houses. I was about ready to buy my own crew. I was a foreman on a framing crew, building custom high-end homes in Jackson Hole, Wyoming. And then 2008 happened, and I only had one marketable skill, swinging a hammer, and I realized that I couldn't do that anymore. So I'm back to school, got a degree in economics, I worked for Goldman Sachs for about a year, and then went on to law school, graduated from law school, 7, 8 years ago, and have been doing essentially tax law ever since. I also have a master's in accountancy taxation that I got jointly with my law degree. So if you have tax questions, legal questions, that's us, right? Now I just want to break down kind of some major aspects of our business and kind of tell you what we do. We have 5 major sources that we can help you with. And this is what we're going to talk about today. Asset protection, number one, we're going to set up your LLCs. Lee talked about how we set up LLCs for him. We do retirement planning, talked about self-directing your 401k, your IRA. We're going to talk a little bit about that today and some of the effects that I see coming down the road. We also have estate planning, tax planning, and then what was our 5th one? Hey, I guess I forgot. It'll come up later. But that's where we were able to help you out with. So if you feel like you need some help with that, start listening to that Main Street Business podcast. When it's a lot of questions there, we got a lot of free information out there. Mark and Matt have a ton of YouTube videos out there that are free. So feel free to jump into there. All right, there's my spiel. Now let's jump into it. So I want to break it down into kind of some different sections, some different areas where we see some a lot of investors getting invested in. Now, for the most part, is everybody here doing long-term rentals? Or we have people doing short-term rentals? Do we have fix and flip guys, development guys? What kind of real estate are you guys investing in?
Long-term rentals for us.
Okay, long-term.
Same for me.
Okay.
Same for me.
Anybody doing anything fix and flip, development-wise, things like that?
I'm doing fix and flip right now, and Steve might be on here later on, and he's my partner that we're doing it together. He does them all the time. So, yeah.
Great. Great. So let's dive in real quick and just talk about a few different areas of real estate investing. So I'm going to break it down into active versus passive. Now, everything you guys have said so far can be considered passive. So your long-term rentals, your short-term rentals, anything where and I like to break it down like this. An active business is a business where your services, your labor is what's creating the value. And a passive business is a business where the asset itself is creating the value. So we think about this like a long-term rental. They're not paying you because you're such a great landlord. That's not why they're paying you $1,000 a month to live in the place, right? They're paying you because it's a valued asset that you own, and they're wanting to live in that asset, and so they're going to pay you for that asset. It's passive. Whereas if you were doing, let's say, a fix and flip, well, the asset itself was worth $200,000 when I purchased it. I put a bunch of effort and labor, and I paid a bunch of people, and I did my own general contracting work maybe, or whatever, and then I ended up selling it 6 months later for $300,000. Well, where did that increase in value come from? That didn't come from just the asset itself. It didn't appreciate by $100,000, although in today's market, that's not at least not in Idaho. That's not out of the box. Housing prices are going crazy. But if it's your labor that created that asset, that created that value, that additional $100,000 in value. It was your labor, your expertise, your knowledge in the industry that created that extra value. Wholesaling, same thing. If you're wholesaling a deal, it's not that the value of the property went up in the 2 weeks that you had that under contract. It was that your labor of going out and finding the right buyer for this property created that additional value. That's going to be considered active income. Now, anything where the asset is creating most of the value, now there's exceptions to this, but where the asset is creating the value, that's generally going to be passive. Difference between the two. Both of them, in a lot of cases, are going to be subject to ordinary income, which means your tax bracket, whatever tax bracket you're in, you got your W-2 job, your spouse got their W-2 job, you've got rental properties income coming everywhere. Everything combined, whatever your AGI is going to be subject to this ordinary income tax. Everything is going to be subject to that when we're talking passive and active income. The third type of income is capital gains. That's the only type of income that's going to be outside of that ordinary, get out of that ordinary income tax bracket. But the difference between passive and active is the active income is going to be subject to self-employment tax. So if you have an active income from fix and flips or from other activities that are considered active for tax purposes, those are either going to go on your Schedule C of your personal tax return as opposed to passive activity, which is going to go on Schedule D or Schedule E. You're going to have that Schedule C income, or if it's from a partnership, I guess the active could come through Schedule E, but that's nuanced. But if you have this active income, it's going to be subject to self-employment tax. Now, the important part here is that self-employment tax is 15.3% on the first $154,000 you make. So if you don't have a W-2 job where you're making more than 150, or if you don't have anything else going on, this active income is going to have an additional 15.3% above what you would be taxed on that same asset if it were passive, right? Will you be taxed on that same income if it were passive? So thinking about that active income, I want to keep it separate from my passive income. This is the first concept I want to bring to you. I want to keep my active income separate from my passive income. Anytime I join those two, it's going to make my tax return a little bit more complicated. If I have passive income and active income and I have some deductions I'd like to take, I'm going to try to take those against my active income, not against my passive. It's going to be way more powerful if I take it against my active income. So I like to separate those for that reason. I like to separate them because there's issues in the future if I end up having that active income taxed as an S corp. I run it through an LLC taxed as an S corp. You're not going to want to own assets in that same LLC. So there's different aspects, different reasons why we want to keep these separate. But I'm going to separate that out, active income versus passive income. This gives us a picture, right? So our active income is subject to self-employment tax. What are some issues that we were supposed to be talking about some of the strategies and whatnot to plan for possible future tax changes. Well, active income right now is qualifies for QBI, qualified business income deduction. It's a 20% pass-through deduction on all pass-through income that you make. As long as your income for a married filing jointly is below 315 grand, you're going to get that 20% pass-through deduction as long as it's active income. Now that 20% pass-through deduction is slated to expire. So unless Congress gets together and says that we want to extend this, it's just going away, whether they do anything or not. We don't have to have votes. We don't have to have Congress actually take any action, and it's going to go away no matter what. So, and that's slated to start phasing out and go away by 2027. So there's number one. We have some phase out of some of those active rules. Additionally, the Tax Cuts and Jobs Act as a whole, so those lower tax brackets that we're all experiencing since 2018, those are all slated to go away as well. Now, other than that, your active income isn't going to change all that much with the new laws that are being proposed. And I want to just back out of this as well and talk about how everything that we're going to talk about today, I'm still planning as if nothing's going to change. My plans today are as if nothing's going to change. That's my standard recommendation. Now, if a client feels like these laws are going to get passed and they feel like they're going to get hosed if they don't do something to plan for it, I'm leaving that on my client. I'm not going to go out here and pull out my crystal ball and say that this is all going to happen, that all these laws are going to change. I'm going to stick with operate as if the law isn't going to change. And then hopefully if the law does change, hopefully they vote on it in July or August and they give us until January to figure things out before they go change things on us. And that gives us a little bit of time to plan. And it's not perfect. And maybe there would have been a better method, but I just don't want to go out there planning and doing a bunch of stuff to change my strategy in anticipation of something changing and then nothing ever changes. and now I'm, stuck out here looking like a fool. So here are the changes, the main changes, and most of the changes that I'm going to talk about are going to come on the passive side. So the first big one is capital gains taxes. They've been a hot button topic for, I don't know, a couple decades, right? Since before I was old enough to be paying attention, right? It's been a hot button topic about whether or not we want to increase capital gains rates or decrease them, or what we should do. And there's, two sides of the coin. And the party in power right now is saying that they want to increase it. So that's why we're talking about it. As part of the Democratic platform, they want to increase these capital gains taxes. Now, there's a couple of different proposals out there. Some people want to just get rid of them and have them taxed at your ordinary income tax rates. Other people want to just have more tax brackets so that if you're making more money, your capital gains rates will go up to 25, 30, 35, and different things. Now, I don't know what's going to happen here. So again, no crystal ball, but that's one thing we got to be aware of, that capital gains rates could be going up. And so with that in mind, some people are preparing for that. Some people are, taking some capital gains now, when otherwise I wouldn't recommend this, but they're taking some capital gains now in anticipation of these capital gains going up. So there's some planning that can be done there. Not something I'm recommending as of right now. It's more of something that I want to reconsider, just have your heads up, have your eyes open, so that these might be coming down the road. So if you start hearing some of these things, just know that there are some strategies we can use to offset these, although it might be too late by the time we decide to implement these. So again, no crystal ball, but here we go. So number one, capital gains rates might just be going up. Nothing's been said yet. I don't see an executive order out yet. And hopefully if they do that, they do it post dated to the next year, and so it gives us some time to prepare for that. Next thing is, speaking of capital gains rates, right now there's a personal residence exclusion, which means your personal home. So this is, for a lot of people, this is the biggest investment you have. You have a lot of these rental properties, but your personal home is the one with the most equity. It's very common for real estate investors to operate like this. That personal residency exclusion is so I buy my home for $300,000, and then I sell my home, 5, 10, 15 years later for $550,000. As an individual, there's not going to be any taxes on that. I paid $300 for it. I didn't depreciate it during the time because I didn't have it rented, so it wasn't being depreciated. And then I sell it for $550,000. There's a $250,000 exclusion, and I don't have to pay capital gains on that $250,000. Now, this rule is you have to own and live in the home 2 out of the last 5 years. So for a lot of people, this is when I used to build houses, the company I worked for, there were a couple of people on that crew that would build a house every 2 years, right? They build their own house, and there's a ton of capital gains sitting in it. There's a ton of equity sitting in it. They got to own it for at least a year to turn it into capital gain. Otherwise, it's going to be ordinary income subject to self-employment tax. So they hold it for at least a year. But if they hold it for 2 years, now they can avoid taxes altogether because they live in it for 2 years and then they move out. Fairly common strategy among real estate investors. Try to take advantage of that personal residency exclusion. Well, that's on the table, right? That's specifically laid out in the Democratic platform, saying it's on the table for being expunged. So if we lose that, just be ready for that. There's also some gossip out there that rather than getting rid of the whole thing, they're just going to get rid of the spousal benefit, which there's a $250,000 benefit per spouse. So if you're married and your value of your property went up by $500,000, you still have no capital gain. So you have a $500,000 increase. I have a lot of clients in California where this is exactly the case. Bought a home 15 years ago and the prices just went through the roof, and they're sitting on $500,000, $600,000, $700,000 in capital gain. Now, there is some planning with that. If you're sitting on a home and you're living in it and it's got $500,000 in capital gain, there's a lot of strategies out there to go and take that gain now, even though maybe you're not planning on moving out, maybe you're not planning on selling the property, but there are ways to take that gain now so that we can take advantage of that $500,000 exclusion or $250,000 exclusion and still maintain that property. Or if you want to sell it, this might be the time to sell it, just to try to get that $500,000 exclusion. Okay, on the topic of exclusions, another exclusion that's on the table is, well, it's not really an exclusion, it's a step up in basis. So a lot of you may have heard that when you pass away, that your heirs will get a step up in basis in the value of the home to the value of the property when you pass away. So I've got clients that, you know, like I said, I pick it on these California clients, but they bought a property in Malibu in 1970, right? And it was $200,000 back then, which was a very expensive home back then. But now those properties are worth 10, 9, 7, $3 million, right? Significant amounts of money in these little 2-bedroom, 1-bath homes, but they're on the beach, right? So, but they've got this incredible value in these properties. Now, if they sell these properties the day before they die, they're going to pay capital gains on that entire amount, on between the $250,000 they bought the property for to the $3 million the property is worth today. They're going to have a lot of capital gains. They're going to lose a lot of that income because of those capital gains. They'll be in the 20% tax bracket, and they'll have some significant taxes there. Now, however, when they pass away, their kids or their spouse or whoever inherits the property is going to get a step up in basis to the value of the property at the time they passed away. So we're a husband and wife. I'm not going to get into that, but it's based off of how much equity each of you has in the property. So if we're 50-50 owners, like in California, like in Texas, a community property state, we're 50-50 owners. If one spouse passes away, then half of the value of the house is going to go up. But the other half, if the second spouse sold it after that, they're still going to have gain, right? But the one spouse, their gain will get wiped out. Okay, they'll get a step up in basis on the one spouse's side. But for single individuals or for rental properties or for something where, where there's a significant amount of gain here, you get a step up in basis at the time you pass away. If you give it to your children, this is a huge topic for a lot of real estate investors. I buy a property, I'm going to depreciate the crap out of it, right? I'm just going to depreciate it as much as I possibly can while I'm alive because I'm trying to reduce my high level income. But at some point, there's a train coming, right? I'm going to have to pay all that back. If I sell this property, I have depreciation recapture. I got to pay that back. I'm going to have capital gains. I got to pay all that appreciation back. There's a train coming and you got to watch out for that train. But if we can wait until we pass away, that train can be averted, right? I don't have to pay any of those taxes back. I got the benefit of owning real estate my whole life, but then I was able to pass away. I was able to dodge that, right? And hand my real estate on my kids. So when I have parents all the time, I just had this happen a few weeks ago where I had a local guy, and dad handed him his farm. Dad was 92 years old, right? And gave his son his farm. He deeded it over to him while he was still alive. And the farm was worth $3 million, something like that. A lot of land. They don't make that much money off. He's only making 100, 200 grand a year off this farm, but it was a lot of land, and the value of that land is huge. And he could have got a step up in basis to the value of the property now. But his dad received it from his grandpa when he was younger. And then, grandpa, so they haven't taken any step up in basis since like the 1800s, right? And they've just been passing this property from kid to kid, or from father to son for generation after generation. Huge tax strategy to pass that on to your kids. Now, again, that tax strategy is on the table. May not have that same exclusion that same step up in basis that we used to. But again, operating as if we still have this strategy, I'm still going to recommend holding on to real estate until you pass away. Do not gift it to your children 5 days before passing away, like what happened in this situation. Just a terrible, terrible tax strategy, right? Make sure you hold on to that property if you can. The real estate should be the last thing that you sell, when you pass away. Make sure you hold on to that. If you can. Obviously, if you need it, you're going to sell it, live off of it, pay the taxes, whatever, right? At least it's capital gains right now, right? So we're still good. But I want to use some strategy with that. But just know that that's on the table for possible change. Oh, well, I'm going to pause real quick if we want to just ask anybody, see if anybody has any questions about these three. I think I only went over 3 strategies so far before we go on to the next one. Anybody have any thoughts? Questions? Take that as a no. Okay. All right. What's the next strategy I want to talk about? Okay. The next strategy, I'm going to shift gears. So the last 3 strategies we're really talking about passive rental income. That's the passive game. The next thing I want to talk about is inside your retirement accounts. So I have a lot of people, a lot of clients who are investing hundreds of thousands, if not millions of dollars in their retirement accounts. They worked at, you know, Boeing or Exxon for 35 years and just have this ridiculous 401k, right? And they retire and they're wanting to do something with it. Stocks, bonds, and mutual funds are making you 7%. I want to go do something else with it. Lee's doing this, right? Investing is retirement accounts into real estate. So, or some other asset, Bitcoin, I don't care, but if we're investing into some other things. Now, this isn't necessarily a real estate strategy. This is more of a 401k retirement plan, IRA strategy. With the thought of the Tax Cuts and Jobs Act reduction in taxes expiring, and with the thought of the current regime contemplating increasing taxes significantly on everybody, there are some strategies that people are starting to implement, and that is chunking. If our taxes do go up, and this is your regular ordinary income taxes, your ordinary income tax brackets, if those start to go up, there are some strategies out there to try to shelter some of this income from taxation. So I'm going to break down retirement plans for you just so we're on the same page, make sure we're all speaking the same language. There's two different types of retirement accounts. Now we talked about 401ks versus IRAs. There's also a SEP IRA, a simple pension plan, defined benefit plan. There's a lot of different types of plans, but there's really only two types of accounts when it comes to how it's taxed. There's traditional accounts and there's Roth accounts. So I can have a traditional 401k and a traditional IRA, and I can have a Roth 401k and a Roth IRA, right? I can have multiple accounts underneath there where I have multiple Roth and multiple traditionals. I can have all this different structures set up. But there's two different ways that it's going to be taxed. A traditional IRA or a traditional 401k or a traditional SEP or whatever type of account is going to be taxed when you take the money out, which means I get a deduction when I put the money in. So I have my boss take $500 out of my paycheck and put it in my 401k. I can have that. It's a tax write-off for me, so I don't pay taxes on that $500. And that $500 goes into an account. It grows tax-free, so I can buy and sell stock. I can buy and sell real estate inside the 401k, and I'm never going to pay taxes on that as long as it stays inside the 401k, absent a couple of other strategies I'll talk to you about, UBIT and UDFI and some other reasons why I might have to pay taxes. But for the most part, I'm not paying taxes on these transactions, especially if I'm just doing stocks, bonds, and mutual funds. However, when I take the money out in retirement, so I'm 65, I decide to retire, and I want to take out $50,000 a year out of this account as part of my retirement. Well, now I'm going to be subject to taxation. 50 grand a year is going to be subject to tax, plus my Social Security, plus my pension, plus my whatever. I'm going to have a bunch of whatever my income is at that time. I'm going to pay those taxes on it. Now, a Roth account is different in that I pay the taxes now. So if I think I'm going to be in a lower tax bracket now than I will in retirement, or if I think taxes are going to go up or whatever, I can pay the taxes now, and then I put money into a Roth account. There's no tax benefit for me to do this today. I don't save a dime of taxes today. In 2021 tax return, I'm not saving a dime. But the money grows tax-free, and then when I take the money out at retirement, I get to take it out tax-free. So the huge benefit here is, what if that account doubles, triples, quadruples, just grows and grows and grows? Now I have all this income-free gains. So that's my Roth account. Now, one strategy that people are using in order to avoid those if we know our tax rates are going to go up, whether you're increasing your income personally, you're planning on making more money, you're starting a new business, you're planning on making more money in the future, or if you think that just the average tax rates due to the Biden tax plan are going to go up. Either case, if you think your taxes are going to go up, it may be a good idea for you to start chunking. This strategy chunking is where I'm going to take these traditional IRA dollars, or traditional 401k dollars, and I start converting those to Roth dollars. So I'm taking the tax today, and I can do this at any time. So I put $5,000 a year into my 401k for the last 5 years. I got 25 grand sitting there. Well, hopefully it's more than 25 grand. Hopefully it's been growing. Let's say it's 35 grand sitting in there. I've got $35,000 of traditional dollars sitting in my 401k. I can take that $35,000 and just convert it to Roth. I've got to have an employer who lets me do that. Luckily, my employer lets me do that. We kind of teach this for a living, so he's got to make it pretty free for us. But if you've got to have an employer who lets you do that, or you've got to be retired and now it's in your own personal IRA, or maybe you have a solo 401k because you're your own employer, but you got to have an account that's going to let you do this, that has the option for a Roth account. But you start converting that $35,000 over to Roth. Now you're going to take a tax hit today, but I'm taking the tax hit today based off of today's tax rate. I have a client in 2020, I had a record number of clients talk to me about this because so many people lost their income. They're all small business owners, and people weren't paying for I have a restaurant. People weren't coming to my restaurant. People weren't paying for my food. I had clients who were, Uber drivers. Well, nobody wanted to get in an Uber with anybody, right? And they just lost their income all of a sudden 1 year, making six-figure income as an Uber driver, and then all of a sudden drop it off to $20,000 last year. And in a year like that, where you experience a downfall, or you maybe took a bunch of, let's say you're a real estate professional and you took a bunch of bonus depreciation in 1 year because you bought a bunch of properties and you took a ton of bonus depreciation, drastically reduced your income. Maybe it's not a bad year, maybe it's a good year, but you just took a hit on your income because of whatever reason. Well, use that year, use those lower tax brackets to start jumping in and converting your traditional IRA or traditional 401k to a Roth. Take those taxes in those good tax years where I'm in that, lower 20 to 12 to 22% tax bracket. Take those gains in those years. And this is a strategy that I recommend all the time, regardless of whether I think taxes are going to go up. But if the Biden tax plan is to have taxes go up, I want to be ready for that. Right. And so if I hear about them going up, maybe I want to take some of these gains in advance, prepare for that. Now, this strategy, the reason it's called chunking is because I don't do this all at once. If I've got $500,000 in an IRA, I'm not going to take that $500,000 in gain in 1 year. That's not going to happen. That's just a bad idea. Because even though the top tax brackets are going to go up, I might not be in the top tax bracket. So I'm going to take these gains, up to a certain tax bracket. So let's do an example real quick. Now, let's say I have somebody's married filing jointly, and they make, let's see, I'm going to say, $60,000 a year. $60,000 a year, and they have $200,000 in their 401k. If they want to convert that $200,000 to Roth, that's going to bump them. Right now, they're in the 12% tax bracket, and that's going to bump them all the way to the 24% tax bracket. So they're going to pay 24% on most of that income that they're taking in if they were to convert that all in 1 year. So instead of doing that, we recommend transferring a fraction of that every year. And in this situation, my recommendation would probably be, I'm going to bump them up to the top of that 12% tax bracket, because everything below, so the first $24,000 a married couple makes is tax-free. First 24 grand because of the standard deduction. Essentially, the next 20 grand is taxed at 10%, and then the next 60 grand is going to be taxed at 12%. So if I've got a couple who's making 60 grand, I've got about $45,000, $46,000 here where they're still going to be in that 12% tax bracket. That's where chunking comes in. I'm going to take $46,000 or some number short of that, and I'm going to convert that to Roth this year. And then I'm going to take that same number, $46,000 next year, assuming their income doesn't change and the tax brackets don't go up and whatnot. I'm going to take that same dollar amount next year. I'm going to take $46,000 a year over 5 years. Now, instead of paying 24% tax on most of this income, I'm going to be paying 12% on the whole thing. So a little bit of a chunking strategy. You can research chunking, research Matt Sorensen chunking or Mark Kohler chunking, and they've got videos out there talking about the strategy and how to convert money over to Roth. Now, this is a strategy you can implement whether you think taxes are going to go up or not, but it just incentivizes you to do it now with taxes possibly going up. So good chunking strategy. So Lee, are you mostly over into Roth, or are you still operating in the traditional world?
No, even though I'm old, I still put everything I can into Roth. As soon as the company makes theirs, it goes from traditional over to Roth, because I'd rather it grow and be tax-free when I pull it out than being like it is now.
Yep, 100% agree. 100% agree. Yeah, I look at my pay stub every month and I see how much taxes I'm paying. It makes me want to throw up, but I'm still putting money into a Roth, right? Because it's just, there's no better way to save money on taxes than to never pay it in the first place. And this is literally the only way you can make money with never having any tax implications. If I make it inside the Roth, There are no taxes on it. When I take it out, I can make as much money as I want. I can double, triple, quadruple my money. Doesn't matter. I'm not going to pay a dime of taxes on it as long as I avoid UDFI and UBIT taxes. So if we're talking on that topic just real quick, I want to explain UBIT taxes to you. If I'm operating inside my self-directed 401k, now if you're at an employer 401k, they're not going to let you do this, right? Most likely. Again, my employer, all good, but your guys' employers probably not, right? But if you have a solo 401k or you've pulled your money out, you're sitting with an IRA, Roth or traditional, doesn't matter, or a SEP or a simple plan in your small business, and you have these retirement funds. The only way these are going to be taxed while you're using them is if you have UBIT, unrelated business taxable, or the UBTI, unrelated business taxable income, and then the UBIT is unrelated business income tax. It's the tax that's taxed on UBTI. So if you have UBTI, you're going to pay taxes on it, and we got to avoid UBTI inside our retirement plans because we don't want to. It's a terrible tax bracket. Basically, anything over $13,000 that you make in a single year in your 401k is going to be subject to that 37% tax bracket. Terrible, right? They have the same types of tax. There's only 4 tax brackets inside an IRA or 401k. They use the trust tax brackets, but you're going to be paying a significant amount more taxes if you run a business inside here. So some ways that we avoid that and is to any of those passive activities. As long as I'm not flipping homes inside my IRA, I'm safe. As long as I'm not running a restaurant inside my IRA, I'm safe. Anything that's going to be considered passive, that from that conversation earlier, is not going to be subject to UBIT tax generally. Now, there's one type of UBIT that might catch you, even though you're operating in a passive business, it might catch you. One rule with IRAs, first of all, is that if you have any debt associated with the property. So let's do an example. I buy a property for $100,000 inside my IRA, but I don't have $100,000 inside my IRA, so I'm going to use seller financing. Now, the reason I say seller financing is because most banks aren't going to give you financing with these terms. If you're going to go to a bank and get these financing terms, you're going to be dealing with North American Savings Bank, Titan Bank, Flair Bank, one of these banks that will operate and do these non-recourse loans, because you can't personally guarantee this debt. And so if you have a loan inside an IRA, you personally can't use your credit score, use your credit to get that loan. You can't personally guarantee the loan. So you're going to be getting, at these banks, they're going to want 30% down, 40% down. They're not going to take 20% down, 10% down, any of that stuff, right? Not at these banks. So let's say I do seller financing and I put 20% down on this $100,000 home. I have $20,000 inside my IRA. Now, you guys have done this deal, probably before outside of your IRA. So what's the difference here if I do it inside my IRA? Inside my IRA, no personal guarantee on the debt. Additionally, you're not going to get any of the tax benefits of taking depreciation. Now, if you have debt on this property, you are going to get some tax benefits inside the IRA, but you're not going to be able to take those losses against your ordinary income like you can outside of an IRA if you're a real estate professional. So you're not getting any personal tax benefits. Another rule is you're not allowed to, write off your home office against this rental property. You're not allowed to write off meals if you talk to people about this rental property. You personally don't get any tax write-offs for this. Because you already have the tax benefit. When I put the money into the IRA, whether it's traditional or Roth, you're getting your tax benefit inside the IRA itself. They're not going to let you take any additional write-offs on top of that. Your mileage to go visit the property, XYZ. Now, on that note, I'm not also going to be visiting the property as much because you're not allowed to put any effort into this building. If you put effort into so if I do a fix and flip, or if I do a remodel, I guess, on a long-term buy and hold, you're going to want to hire other people to do the work. You can pick the color of the walls, but you can't go out there and paint them. You can pick what tile to put on the floor, but you can't be laying the tile, right? You can administrate over the remodel, but you can't actually do the remodel yourself. So those, a couple other rules. The other rule is if I do have debt associated with this, now we're subject to a type of UBIT, which is unrelated debt financed income, UDFI. And that means if I have debt associated with this property, I have to pay taxes on whatever income is generated from that debt. So with debt comes a little bit of taxes inside the IRA. Now, 90% of the time, those taxes are nominal because depreciation is going to wipe out the income from that property anyway. So we're not going to really have any income to pay those taxes on, but you are going to be subject to those taxes. We got to be watching out for that. Watch out for that UDFI. So other than those two narrow circumstances where I start a business inside my IRA, or if I have UDFI, we're going to be able to avoid taxes while this thing's growing, and you don't have to pay taxes until you take the money out with a traditional IRA, or like I said, with a Roth IRA, you pay the taxes in the first place, and then you never pay taxes again. Okay. Lee, was there any other strategy, any other of the Biden taxes changes that you wanted me to go over today, or is that that's pretty much all I had?
Wanted to point out, and you correct me if I'm wrong, but I believe that the 401k is not subject to that tax on the interest on the loans.
Absolutely. So yeah, 401k is not subject to UDFI. So that's absolutely true. So if I have an IRA and I qualify for a self-directed 401k or do a solo 401k, a lot of times I'll have my clients convert over to a solo 401k just to avoid this UDFI. Now, it's not that the UDFI is going to be significant. A lot of times the actual dollar amount that you're going to pay is insignificant, but a lot of times it'll save you $750 a year for having to file the tax return, right? Because your IRA is going to have to file a tax return to report the income. Now, the tax you might be paying might be $200-300, but you're paying somebody $700 to file the tax return for you. That's generally not not a good idea. So I'm recommending, if you qualify to get into a solo 401k, to try to avoid that, so you just don't have to file that tax return in the first place. Great. Any questions from anybody else, or Lee or anybody?
What were the names of the two guys you said to look up or Google for chunking?
For chunking, that would be Matt Sorensen, MattSorensen, or Mark Kohler, MarkKohler. MarkJKohler.com. I can post these in the chat probably, and just do J. Kohler, Matt Sorensen. There we go. Their names are in the chat. Just type their names into Google. It'll show up. MarkJKohler.com. Matt Sorensen's website is the SDIRAhandbook.com. And they have
imagine something. Is a 401k reliable?
Is the 401k reliable?
Yeah.
How do you mean?
Like, you think it's worth like, having a lot of money inside the 401k, if at the same time like didn't it crash before and lost like significant amount?
So yeah, that's if you're going to invest in your 401k into stocks, bonds, and mutual funds. So let me break this down for you. So an IRA, a 401k, a SEP, those are not investments, right? Those are the vehicles. So I have, 5 tractor trailers, all right, big 18-wheelers. This is sore subject, I guess, for you guys down in the Dallas area, because you just had that 133 car pileup. But you have a couple of tractor trailers. You have a lot of different options. The tractor trailer is the 401k or the IRA or the SEP. I've got a bunch of different tractor trailers driving on the road. What's inside the tractor trailers, though, will be the investment. So inside the 401k, I can invest in stocks, bonds, and mutual funds. If I'm worried about those crashing, I can get out of stocks, bonds, and mutual funds, and I can invest in cryptocurrency or gold and silver or real estate, which is what we're talking about here. I can invest in whatever I want to invest in. The difference in between investing in real estate versus stocks, bonds, and mutual funds in the IRA or the 401k, it's not a tax question. Now, the reason we invest, and you guys have probably been through this a million times, but the 4 quadrants of savings inside, or the reason I invest in real estate, because of the 4 quadrants, right? We have the appreciation of the value of the asset. So I buy a property for 200 grand. It's going to go up 5% per year over the next 10 years and be worth X at the end of my investment. Obviously, there's that. There's number 2, the cash flow from the property, because I have rents being paid off from this property, and I a lot of times don't have to pay taxes on those rents, which is a different strategy or a different benefit. But I'm going to get rent paid off from this property, so I make another rate of return. On top of that, I'm going to have somebody else is paying down my mortgage, right? So somebody else is paying down my mortgage. That's a great strategy. Real estate's a great strategy because of that. And then the fourth benefit is the tax benefit. I don't have to pay any taxes on that. I have a client who has 250 doors. He doesn't buy his doors the way we buy our doors. He buys them in bulk at Costco, right? He's buying them 17, 25 at a time, right? In apartment complexes. He's got 250 doors. He makes 800 grand a year in his day job, but he makes 200 grand a year from these 250 doors. So he's able to make $200,000 a year, but because of depreciation, it's tax free. He's in a high tax state. He's paying 50% tax on most of his on his income, everything over 600 grand, right? But he doesn't pay any tax on this 200 grand. That's like making 400 grand for him, right? It's huge. It's a massive tax benefit. And that works for somebody making 60, 70, 80 grand a year too, right? You get this extra income that you don't have to pay taxes on. It's a fantastic, fantastic strategy. On top of that, if you're a real estate professional like his wife is, you're able to take those passive losses. He has about $160,000 worth of losses in 2019. So in 2019, his tax return looked like this. He made 800 grand. Wife's a stay-at-home mom, so she's a real estate professional. She manages the rentals for her business. He makes 200 grand cash from these rental properties, cash flow. And then he takes $160,000 in losses because of depreciation, and it is bonus depreciation, cost seg analyses. You guys have heard these terms, I'm sure. And he's able to take that $160,000 in losses against his ordinary income. So if you're doing the math, he made $1 million in 2019, but he only paid taxes on 640 grand. That's the power of real estate outside the IRA. But if we're doing inside the IRA, the power is it's making you a way better rate of return than the stock market. Stock market last year, I mean, we had a fantastic stock market break last year, just blew up, right? And I think average nationally was like 15.8%. I have clients and myself have owned real estate that I'm making 25, 30, and that's not even that big a deal. You guys make more than that, right? There's probably somebody in this group who makes more than 30% on it, in their real estate last year, right? You can make way better rates of return a lot of times in real estate. Now, I'm not here to sell real estate. I'm just your asset protection guy. Whether you're going stocks, bonds, and mutual funds, or whether you're going real estate, I'm gonna help you either way. But it's generally, that's why we do real estate, because I'm gonna make a better rate of return, and there's something solid to attach it to. What is a GE stock? We thought it was bulletproof, right? 20 years ago? Lee, if I'd have told you 20 years ago that GE stock was going to go down to below $1, would you believe me? Right? No. Insane. They own everything. Why would they go down? That makes no sense. But it is. It's gone. It's basically, I don't even know where it is now, but like a year ago, it was like at $1. It's insane. It's insane that it went so low. So, real estate can't, it can't go to zero. I guess it could in theory, but it's really improbable for real estate to go zero. Will it drop like in 2008? Sure. Right? It can. But if you're in it for the long haul, let's do this. I have a ton of clients who were around in 2008, and they had a boom in 2008 because all of a sudden rental properties got real cheap. Right. And they had renters sitting in their rental properties now who were locked into contracts and they were willing to pay the rent. And guess what? All those people who moved out of those houses they couldn't afford anymore had to live somewhere. Come live in my rental. Rental prices actually went up in 2008. So even though the housing market crashed, there's certain areas of the housing market that did very well. And I have a lot of clients who made their fortunes waiting until 2008 happened and then buying up all the other houses that everybody was bailing on. Right now they got this huge, real estate portfolio. So real estate is something that's, if you know it, and I'm not telling you invest in real estate versus invest in stocks, bonds, and mutual funds. That's not my job. I'm not a financial advisor. I'm just saying that you guys are real estate professionals and you know real estate, right? You guys understand this. Whereas stocks, bonds, and mutual funds, I don't even think my broker knows what's going on over there. He's just guessing, just crystal ball guessing all day long, and charging me a fee coming and going, I'm sure. But you guys know real estate. You know this. You know whether it's a good buy. You know whether it's a bad buy. You've been researching this. You studied this. This is what you do. You feel more comfortable with it. That's why we invest in real estate instead of our IRA, because I think I can make a better return and because it's something I know and I feel comfortable with. I don't have to rely on Jeff Bezos making a bad decision. I get to rely on me making it. If I make the bad decision and I buy a bad piece of real estate, at least it's on me, right? I have some control over the situation. Okay.
I have a question. how do you calculate the taxes when you transfer from traditional to Roth IRA?
Yeah, so it's going to be a conversion. So if you're dealing with a custodian, so a 401k, even a solo 401k, you can have a custodian with that solo 401k. And our sister company, Directed IRA, does this. And if you're operating with a custodian, they're essentially going to send you a 1099-R. Now, if you have a solo 401k where you're managing the 401k, which is also an option if you set up your 401k with us, where you're just managing this thing yourself and, you know, say skip the custodian, then you just essentially have to issue yourself a 1099-R. The 401k itself is going to issue you a 1099-R. And it's just going to be reported as income as if you'd made money elsewhere. It's not going to be subject to self-employment tax, which is why it's a 1099-R instead of a 1099 miscellaneous. But yep, good question.
So it's like any additional, this is like any additional income is going to be treated like that.
Yeah, just like any additional income. I went out and drove Uber for the weekend. Except for Uber, I'm going to be subject to self-employment tax. So this is like, I got a dividend from my co-op. This is actually, I just did my taxes the other day. My healthcare was a co-op. My health insurance provider was a co-op, and they sent me $600, right? Because I'm a co-op member and they profit sharing or whatever, right? It's not subject to self-employment tax, but it is subject to ordinary income tax. So it's just an extra amount of money, but it's passive. So it's a passive 1099, if that makes any sense. So not subject to self-employment tax. Good question though. Yep, and the great part about this is I can plan this at the end of the year. I can do this in December. I know exactly how much money I made last year when I decide how much to chunk, right? I don't have to do this in March, April, May, June, although I might, right? I did chunking this year. You guys remember when the stock market crashed in April? I took a big old chunk and was like, hallelujah, you know, like, because I had an assumption that it was going to go back up. And so I took a big old chunk out of what was in the stock market, converted it to Roth while it was low, you know, the amount that I converted just like $14,000 is what I converted. But that $14,000 2 weeks prior was worth 20 grand. And I took that 14 grand, put it into Roth, and then all of a sudden it shot back up, grew 30, 40% in a few months. So a huge Roth conversion while the market was down, and then ride it up. So you can do this in the middle of the year if you think the market's going to do something like that. But again, that's crystal ball stuff, right? I didn't have a crystal ball. I just saw the market go tanking, and I didn't really see a reason for it. And so I went and did a huge conversion. I didn't want to do all of my 401k, right? That would have been a huge risk. But take a chunk of it and gamble. I mean, it's my money. I'll throw it on black in Vegas if I want to throw it on black in Vegas, right? So.
Oh, so you're just guessing, huh?
Just guessing, just straight up guessing. Oh yeah, but it worked, right? You see me smiling? That's because right? Nothing better than throwing those dice and having it come up sixes, you know, like, let's go. Like, we got it. But it was total luck. The market could have crashed two days after I did that. And I converted at $14,000, and now that $14,000 was worth $6,000, right? And that's, ouch, right? That hurts a little bit. It hurts to lose money in your traditional 401k, your traditional IRA. It hurts more when you lose money in your Roth, right? Because you already paid taxes on it. Now you gotta take that loss anyway. Hurts a little more, but it's that's part of the game, right? That's why we play, just having fun.
I'd like to add something that it sounds like the way you described is that there's only maybe 5 or 6 different categories of things that you can invest in. But that's why you got to study Matt Sorensen's book and listen to the podcast, because that's the reason I listen to podcasts, is because I don't know everything. Even though I've studied it quite extensively, I still don't know all the different ways that you can make money. And there may be somebody out there doing something weird that I've never heard of. And it's like, oh, I better run that by Deven and see if that's a good plan or not, you know? So if you're going to get into the 401k and the IRA self-employment thing, study and know what you're doing.
Yeah, the only things you can't invest in, there's only 3 things listed that you cannot invest in your 401k or IRA. That's S corporation stock, because you have to be an individual to invest in S corporation stock. There's collectibles, so I can't go buy, you know, Eleanor from Gone in 60 Seconds, right? Can't go buy collectible cars. And the other thing is life insurance. Can't buy life insurance inside the IRA. So other than those things, you can invest in whatever you want. We have clients investing in, this is something recent that Mark's been talking about, is cattle. But even more interesting than that, I have a client who invests, he's a cattle farmer, cattle rancher, but he had an idea when Barack Obama was president, he took a bunch of BLM land and made it unavailable to ranchers, right? Turned it into monument land and whatnot, and said it was no longer available for ranchers. Well, this guy took a gamble, again, just rolling the dice, kind of like me. He believed that the next time a Republican came in, and he didn't know President Trump was going to win, right? He had no idea. He just knew that the next time a Republican comes in as president, they're going to reverse that and make that BLM land available for grazing again. Well, all the land butting up against that BLM land dropped in value like 80% overnight. As soon as that bill was signed, that the BLM land was off limits for grazing, that land abutting it dropped significantly in value. So he went inside his Roth IRA and bought up a bunch of it, bought a ton of land, just ridiculous amounts, just pennies on the dollar because they were so devalued, and then just waited. And he had to wait 5 or 6 years. But as soon as Trump came into office, it's one of the first things they did is make that land available for grazing again, and the value of that land skyrocketed, quadrupled, quintupled overnight, right? So as it went down 80% overnight, if it just went back up to its original value, that means it quintupled in value, but it actually went up above and beyond that. So this guy went from a couple $100,000 inside his IRA to a couple million in his IRA, snap of fingers, because he knew this market, right? He knows that land is worth more than what it's being valued at if something changes at the federal level and they make that BLM land available for grazing again. So just don't be pigeonholed into saying this has to be real estate, this has to be stocks, bonds, and mutual funds. It's going to be whatever you know well. If it's something you know really well, invest in it. It's 100% up to you. It's like being an insider at Google, right? You know the Google stock was going to go up back in the 90s and whatnot, and you invested in it back then. You know something better than everybody else knows. That let's invest in that. It doesn't have to be real estate. It doesn't have to be stocks and bonds and mutual funds. It can be whatever you know, something you see going up in the future. Anybody else? Questions?
I'm good over here.
So, yeah. So, with that being said, let me just real quick, never mind. Lee, if you want to make it so I can share my screen.
Sure.
I want to break down kind of a structural diagram for these guys if they haven't seen it yet. So Mark and Matt share this all the time. This is in Mark's books. Mark has these diagrams in his books available. So this isn't, proprietary information or anything. This is just giving you some information here. We were talking about earlier in the phone call about active versus passive income. Now, I like to diagram things because I like to think of things in different quadrants and different categories. And I try to explain, at least in my life, I have my own, my IRA, my 401k. My retirement plan is set up as such that I have my income from my day job. I have my income from my wife's small business. I've got income from my small business. I've got rental property income, and how is my 401k going to grow? I like to see things and see the different aspects of my life and be able to take a look at it real quick in a picture. And so I've got this.
You should be able to do it now.
Yep. I'm looking at it now. I'm going to grab this guy right here, share that. So here's my diagram, right? This helps me to at least digest what I'm talking about here. So I'm going to break this down left side, right side. On the left-hand side, that's our active income. On the right-hand side, that's our passive income. Now, income that's passive, life insurance proceeds, investment accounts, stocks, bonds, and mutual funds, right? And also rental properties. On the left-hand side, I might have whatever my day job is, right? This might be a W-2 that's just coming in through here, or if I'm self-employed, I've got fix and flips, I've got a development company, I'm a realtor, whatever it is in your day job, this is coming through on this side. Now, if you're a W-2 nothing I can do for you on this side. There's really very little I can do for you on this side. There's some strategies we can implement on the left-hand side if you're a W-2, but really not a lot I can do for you. They got rid of unreimbursed employer expenses in the Tax Cuts and Jobs Act. There's not a lot I can do for you over here to help you save money on taxes. But if we start doing stuff on the right-hand side, like I said, this guy I told you about earlier in the phone call, $800,000 income, technically he owns a small business, and that's where that 800 grand comes from, but that could have been a W-2. There's no reason that can't be a W-2. So I have some clients who are, husband and wife FedEx pilots, right? And they're making, 300-400 grand a year as FedEx pilots each, right? Because they're doing international travel and stuff like that. And they're just crazy, making a lot of money, both of them working crazy hours and making a bunch of money. Or physicians, right? Husband and wife dentists or something like that. Just making a crazy amount of money. Plastic surgeons in Malibu, California, or something like that, right? Just making tons of money W-2 over here, but they can use real estate as a strategy on this side to help offset those taxes. But if you have a small business, and even if you're driving Uber on the side, right? You have your day job and then you're driving Uber on the side. For example, I'm a W-2. I work for KKOS Lawyers, W-2 income, but I gotta have my side gig. I gotta have my small business on the side. Why? Well, I want to start writing some stuff off. I got LASIK this year. LASIK, vision correction, and it was about $4 grand. Well, that would have sucked to pay $4 grand for some medical procedure like that, but I got a tax write-off for it. I got a tax write-off in my small business, and was able to, at least I didn't have to pay taxes on it, right? So it took away the bite a little bit on that $4,000 expense. Again, you buy a new car, and you want to be able to use that in your small business. If you can justify it in your small business, you can write off a new car. I can write off my cell phone. I bought this. I'm sitting at home in my wife's office. We just bought a new computer setup in our home office. Got a couple of monitors, and it's a lot nicer. Ever since I started working from home, all of a sudden she got an upgrade. And technically her office, right? But if I'm going to be working from home, that little 20-inch screen she had wasn't working for me. So, but yeah, all write-offs in our small business, right? If I'm using these things in my small business, I'm gonna be writing these things off. So a lot of the stuff that you would buy anyway, you're gonna buy anyway, you can write off as a small business tax write-off. So this is our active side. On the active side, I'm generally gonna set this up as an LLC, but at some point I'm gonna recommend having this taxed as an S corp. Usually that's when you hit $40,000 to $50,000 of income, net income after expenses, on the active side. That's if I don't have a W-2. There's a lot of factors here, and I gotta exacerbate this, guys. I gotta say it one more time. What I'm saying on this phone call today is not necessarily legal advice that's tailored to you personally. A lot of what I say is absolutely valid. You can bank on it, but it's not tailored to you. So in your situation, you may not want to do some of these strategies I'm recommending. Chunking is a great strategy if you're in the right situation to use it. But in some people's situation, chunking would be a terrible strategy right now. Switching over to an S corp, if $40,000 to $50,000, I'm not even talking to you about it unless you're making $40,000 to $50,000. It's not even really an option. The cost benefit analysis, it actually costs you more than it benefits you if you're making less than 40 grand. So I'm going to recommend against it until you're making at least 40. But just because you're making 40 doesn't mean that it's time, right? Some people it's 50, some people it's 100. Right, in your side business. So talk to an attorney, talk to your accountant, make sure that you make that election at the right time. But that S election alone could save you $10,000, $15,000, $20,000 a year in self-employment tax. And I don't think I've ever seen anybody save 20,000, but 10, 12, 13,000, absolutely. I had a phone call earlier today, saved the guy $12,000 by switching over to an S corp. Okay, so at least a potential savings of $12,000 in self-employment tax. Now he saved $17,000, $18,000 in self-employment tax, but there's some net effect to that, which is why you didn't save quite as much. Anyway, so this is your passive side, and I have that completely separate from our active side. I apologize. This is your active side. I have that completely separate from our passive side. The reason I do that is, number one, my active business generally has more liability. There's more liability over here if I'm doing fix and flips, right? There's more liability in fix and flips than there is in just owning one passive piece of rental property. Right? There's people climbing up ladders, shooting nail guns, licking black mold off the wall, sucking down asbestos out of the attic. Probably not a good strategy to have that mixed up and have my rental property over here. Because if they sue me inside this LLC, they get everything that's inside that LLC, which includes my rental property. So I'm going to keep this rental property over here. So there's reason number one. And then I already talked about reason number two is that this is active income, self-employment tax. This is passive. I'm going to keep my passive separate because I don't want my passive being end up having to pay self-employment tax on passive income. I'm going to try to keep those as separate as I possibly can. Additionally, there's a couple of strategies where if I end up taxing this as an S corp and I've got a rental property in there, it can never refinance that property. If I do a refinance out of an S corp, I have to transfer that property to your own name to do the Fannie Mae refinance, and it's being treated as a deemed sale. So you get taxed on it as if you sold it, even though you didn't sell it. And this is where that guy with the $1.6 million, we've got time, so I'm going to just share this real quick. He had 6 properties worth $4 million, but he had them in New York, right? Had these rental properties in New York. Now, he'd inherited these from his father like in 1968 or something like that, right? So forever ago. These things have no basis in them whatsoever. So if he sells these properties, he's going to get murdered in taxes. He's going to get hurt. Now, New York, for those of you who don't know, also has a 20% capital gains tax. So 20% federal, a 15 or 20% federal, there's 2 brackets, and then there's 15 or 20% state. So this guy's in the 40%. If he had transferred all 4 of these properties from his S corp, which all 4 of them were over here, and he transferred them to his LLC to refinance them, he's going to get taxed 40% on $4 million. That's a $1.6 million tax hit if he had done that. If he had the deeds drafted, he was ready to go. He was ready to go record them. Better talk to an attorney first. This is kind of a big deal. Glad he did. Anyway, but there's reasons I don't want my rental properties. I do not want my rental properties over here. It makes him stuck. He wanted to take the equity out of these to go buy more rental properties, but he's going to be stuck with commercial lending. Can't do a Fannie Mae refinance because he can't transfer them into his own name. If he does that, he's going to hit a huge tax hit. So we want to keep these separate, passive and active. Now on the passive side, there's a lot of strategies. You can just scroll through these here real quick. Wyoming Holding Company. You've got separating out your separate LLCs based off of equity and the properties. A lot of different strategies on this right-hand side. And then also, this is considered passive as well, our 401ks and IRAs. So this is just a basic, you guys can take a screenshot of this real quick if you want to see that and keep it for your records, or you can access it later. But this is kind of what we do. We set one of these up for you individually, talk about your business and see how complicated you get. Whether you guys are here or here, we're here for you. Like I said, most of my clients have 1 to 2 rental properties and have a day job. But I have clients who have, like I said, 250 doors, 1,000 doors, anywhere in between. We can help you out and get you in the right structure for yourself and your needs, and then also help you save money on taxes, whether it's through retirement or just through purchasing rental properties on their own, or whether it's with S corp strategies. Whatever you guys need, we're here for you. Okay, and I think we're at our hour. Lee, if you wanted to.
Yeah. Any last question? Because we're about to clock off.
I do have one.
Oh, sorry, go ahead.
I was going to ask in reference to risk mitigation. Do you typically recommend doing series LLCs just to, like you had said earlier, if one property, there's a suit against one property, it's just on that particular property itself and not all your others?
Yeah, series LLC is a great strategy to separate out the value of the properties. In the diagram I had there, that was not a series LLC because those were the only series LLC state I had listed there was Texas. Not every state is a valid series LLC state. So if you're in a state that allows for a series LLC, that is something I will recommend in some instances. Now, a lot of times we'll set up a standard LLC and then we'll convert it to a series later on if you only own one rental property, for example. But yeah, I do like the series LLC strategy. It's a nice way. It's kind of a middle ground. There's 2 ends of the spectrum. A lot of people like to have one LLC and it owns all 15 of my properties. Other people like to have 15 LLCs that own all 15 of my properties. I'm kind of in the middle. I'm going to recommend setting up a new LLC about every $300,000 of equity. But if I'm in a series LLC state, there's no reason not to just set up a series. In some states, they're going to charge you extra for every sub-series that you set up. They'll charge you an extra fee. But in most states, they don't. So having a series LLC is almost a no-brainer in some of these instances. If you've got 4 or 5 rental properties and you want to separate them, they've got enough equity in them to justify separating them, absolutely. Series LLC is a great strategy for that. Somebody else was trying to ask a question as well.
Or, I mean, it goes along with that, the series LLCs. I've heard that getting an umbrella policy, is that something you should get when you, for separate LLCs, or what would be of preference, I guess?
Yeah, I always recommend insurance, and umbrella policies are really cheap insurance. So I'm going to get both. The LLC is designed to protect you when your insurance doesn't. If your insurance is just going to, if somebody slips and falls in I've got 5 properties and somebody slips and falls in property number 4, if my insurance covers it, great. I get to keep the property. I don't have any liability. Absolutely. I want insurance. Plus you're required to have insurance in most states. And if you don't have insurance, a lot of times, at least, sufficient insurance by state law, sometimes they will pierce the corporate veil just because you didn't have proper insurance. So yes, I want you to have insurance, 100%. And umbrella policy, absolutely love the umbrella policy strategy. Have an umbrella policy myself. It's like $20 a month or something like that. Just really cheap policy for how much it's protecting me. But if somebody were to slip and fall in property number 4, and I have these 5 rental properties, what happens if my insurance doesn't cover me? I had it happen where a client had a contractor fall off the roof. Now, before he'd hired this contractor, he was licensed, bonded, insured, checked, everything, right? He's good. He was covered, right? But the guy didn't actually come out and do the work for about 5 months because they were doing other work, and it took him a while before this contractor actually ended up showing up. In the meantime, his insurance lapsed, his license lapsed, and he wasn't licensed, bonded, or insured when he got on that guy's roof. And sadly for my client, and sadly for the person who fell off the roof, a guy fell off the roof. He wasn't lashed in, fell off the roof. And if this guy was licensed, bonded, and insured, everything would have been fine because his insurance would have covered it. He had plenty of insurance. His insurance would have covered it. But the insurance said, you hired a guy who was not licensed, bonded, or insured, therefore we're not covering you. This was a circumstance where technically that guy's insurance, the employer's insurance, should have covered this guy falling off the roof, but he didn't have insurance because he wasn't licensed, bonded, or insured. And so the insurance company denied the claim because this guy hired somebody who was not licensed. Client didn't do anything wrong necessarily. Now, obviously the client, and this might be a learning lesson for you guys, make sure your contractors are licensed, bonded, and insured, right? Make sure and double check and triple check when they show up on the job site. Just show up the first day they show up on the job site and ask to see their card or whatever they've got. But yes, maybe by no fault of your own, you end up having an issue like this. The guy shows you his insurance card and it says it's valid for the rest of the year, but if he misses his monthly payment a couple months in a row, maybe he's not insured, right? Which violates his license, and then all of a sudden he's not licensed. Things like that. Outside of your control, but your insurance ends up not covering it. There's a lot of caveats there on insurance where they end up not covering it. So the LLC is there for those instances. It's also there for the instance where the guy slips off the roof and he ends up dying. Charges you, you get a wrongful death claim, and they're charging you $2 million for lost wages for the rest of the guy's life. Maybe he was a 22-year-old kid, right? And they just get this ridiculous judgment against you. Do you have a $2 million policy, right? Let's hope so, because if you don't, they could be coming after you for the whole amount. So having the umbrella policy is additional coverage, 100% recommended, but I still want to have an LLC. An LLC is going to be there to protect you regardless of whether the insurance decides to or not. I tell people that the first 4 pages, your 80-page insurance policy that you guys never read, because I'm an attorney and I don't read them, so I can probably guarantee that you guys don't read them either. But that 80-page document, first 4 pages tells you what they do cover. The next 76 pages tells you what they don't cover, right? That's all the caveats. That's all the loopholes. That's all the, we're actually not going to pay in this instance. Things that you got to watch out for. Recommend having an LLC in those instances.
Hey, I got a quick question if you have a second.
Yeah, go ahead.
So if you have an LLC, but your property's titles are under your personal name due to financing and getting lending, is your LLC really serving any purpose?
No, it's not protecting you. It'll protect you for, let's say you put the lease in the name of the LLC. If there's a contractual disagreement or something like that, and they sue you under contract, then sure, you'd be protected there. But most of the time, when what we're trying to protect against with your LLC is we're trying to protect against, like a slip and fall case or an injury on the property, some sort of defect on the property, house burns down because of faulty wiring, and you burn people, whether they get injured or not, you're burning their stuff. Those are the types of things that we're trying to protect against for the most part. Those are the big dollar items that we're trying to protect against for the most part when it comes to the LLC. They get a sue if I slipped and fell. I'll do an example. If I slipped and fell in your house, Adam, I'm over visiting and I slip and fall in your house. I get to sue essentially 3 potential people. I get to sue you because you live there, and it could have been that you spilled the water on the floor. You had the actual liability of whatever caused me to be injured. You didn't fix the hand railing, right? And I was climbing up the steps and I fell. Now, it may not be me. I don't want to sue you, Adam. I have no intention in suing you. I'm your best friend, and we hang out all the time. I'm not going to sue you. But I broke my back, and my insurance says they're not going to cover it because they think you're liable. So it's my insurance company suing your insurance company, right? It's not me. I don't want to sue you. But my insurance company won't pay my bills, and I can't afford to pay for my back, so they're going to sue you. So you have your house. They have the person who lives there. Also, I could sue your landlord. Let's say you were renting this place and you had a landlord, a property manager of some sort, and their job is to make sure this place is livable and maintained and all this other stuff. They came in and checked last month, and this handrail has been loose for years. You've been telling them about it. Adam, you've been emailing them. You've been calling them. Come fix this stupid handrail. Let's do this. They won't come fix it. Okay, I can sue them too. There's liability on their side. Maybe I sue them. Additionally, if you and them are not liable, or there's just, you're both broke, maybe both of you don't have any money, and so I sue you, but there's no money there. Well, ultimately, who do I get to sue? I get to sue the homeowner as well. By you having your rental property in an LLC, you're taking that property management, if you're managing your own properties, you're taking essentially that property management and saying, that part is stuck in an LLC. So if I'm suing you based off of, property management liability or contract liability or something like that, now I'm protected. But the house has to actually be transferred into the LLC. Otherwise, they're still going to be able to sue you, right? So I still want to have that house in the LLC. Now, I 100% understand that you closed on the home for Fannie Mae purposes, right? Our strategy is go ahead and transfer the property into the LLC after the Fannie Mae mortgage closes. I do this on my own properties. I've talked to bankers, dozens of bankers, and hundreds of clients who have talked to their bankers, and the banks are perfectly fine with this. As long as you own the LLC, you're not transferring it into an LLC in Juan's name, right? You're transferring it into an LLC in your name. They're going to be fine with you transferring this property in and getting that asset protection. So I would recommend transferring the deed and actually doing the deed transfer.
Cool. Thanks for letting us know. And that's basically the same thing as like a quick claim, right? Deed transfer?
Yeah, good question. Adds another question to the mix here. So I generally recommend doing a warranty deed, not a quitclaim deed. When I do a quitclaim deed, a lot of times I void my title insurance.
Okay.
So if I bought title insurance when I bought the property, that title insurance claim can be invalidated when I do a quitclaim deed, even though it's to my LLC. A lot of times it violates the terms of that insurance, and so I don't have any protection anymore. Essentially, the claim or the title insurance is designed to protect you as an individual, but when you quit claim to your LLC, you're no longer liable. And so that policy is designed to protect you, and if you're not liable, the policy is null and void. So I want to do a warranty deed when I can. Now, if I've owned this property for a decade and nobody's ever come after it, and I'm going to have transfer taxes if I do a warranty deed, and so I'm going to decide to do a quitclaim deed instead, sure, right? But depending on the circumstances, I'm going to try to push you to a warranty deed first, and then we'll do quitclaim deed if you received the property from a quitclaim deed, then who cares, right? Because there's no title insurance, so just have at it.
Cool. Thank you, Deven.
Okay. Good question. And you didn't realize you were asking that second question, but yes, quitclaim deed, technically that's right, but I would rather do a warranty deed if I could.
Well, we all know that your time is valuable, Deven, and we really appreciate you coming. Great information. Thank you, and I hope you all have a good night up there.
Yeah, will do. Thank you so much. We should have just started with questions. Those were good questions, right? Just done the whole thing as question and answer. That would have been good. Anyway, but thanks, guys. Appreciate you. Let me know if you need any help with anything. I'll just throw down my email real quick, if you don't mind, Lee.
Yeah.
Deven at KKOS you guys want to take a chance to look in the chat and pull that email, that's my email address. Feel free to email me with any questions, thoughts. You want to schedule time with me, anything you guys need help with. I do a free 15-minute interview with anybody who wants to set that up, and just to talk about your specific situation, see if we can help. Additionally, obviously we can set up a consultation and whatnot. So just let me know.
Did you happen to see that there's a new client of yours, Aaron Richter?
Is that your son?
Yes, it is. I've been trying to get him to open an LLC for years, and he's finally doing it. So
awesome!
Yay! So, hey, if you guys here, if you lose that email address, you can always get a contact with me, and I can get you to Deven, because I mean,
you can also find me at my email address is on KKOSlawyers.com. You can go to our website. We have blog articles, tons of free information out there. What I recommend for all my clients is go out there and absorb as much free information as you can. Because if we get on a phone call and I'm talking to you for an hour, I bill $400 an hour for my time. It's not cheap. But I would rather be talking to you about your specific situation, dialing it in more narrow into your specific, strategy, rather than just talking to you about some, vague strategy that maybe you never heard of and maybe never thought of before. So go out there, get all the free information you can. MarkJKohler.com, SDIRAhandbook.com, KKOSlawyers.com. All these addresses or all these websites have free information. Mark has over 200 hours of free videos online. How many episodes are they on, Lee, in their podcast? They're on episode 200 and something. And then they just started this new podcast, the Direct IRA podcast. They are just ample amounts of free information out there. So please do your research, use our time wisely. I'm happy to talk to you about the basics too. I like basics too, but I'd rather, when I'm spending the time on the phone with you, let's dial it in, right? You guys already have an idea what's going on. Use my time wisely and your money wisely, and let's really get this thing dialed in while we're on the phone together. Okay.
Thanks, Deven.
Anyway. Thanks, guys. Appreciate you.
thank you. Bye-bye.
Thanks, Lee. Bye.
Thank you.
Well, that's about it. Normally I hang out here, guys, but with all the junk that's going on over the last couple of days with our electric being out, and we had to do a lot of scrambling around town to find a place to stay, and now we're back in our house, and I'm kind of worn out, so I haven't had a shower in 2 days.
Could have been worse.
It could have been a lot worse. Yes, we could have had no place to go, and had to stay in the house here. We got a fireplace here, so we were sort of warm, but not warm. So it's good to be back home with electricity.
Yeah, same here.
Well, I'm going to clock out here. Y'all can talk to each other if you want. I'll just end it for me, and I won't end it for the group.
Thanks, Lee. Appreciate it.
Bye.
Thank you, Lee. Goodbye.